Hey everybody, after 33 years in the mortgage business, there is one common theme that every single home buyer or even someone looking to refinance talks about. And it's what type of mortgage may be best for them, because there's really two main types of mortgages. You have fixed rate mortgages and you have an ARM, which stands for an adjustable rate mortgage. And like anything in life, there's pros and cons. If I want to eat bagels and donuts, I'm probably not going to be very thin. But if I want to be thin, I can't have my bagels and donuts. Well, I'm going to kind of walk you through the pros and cons of each, and everyone has to decide what their risk level is. So let's just jump right into it. A fixed rate is exactly that. It's fixed. It'll never change. It can be fixed for 15 years, 20 years, 30 years. It'll never change. It's a fixed rate. Well, what is an ARM? An ARM stands for an adjustable rate mortgage. It's exactly that. It's adjustable. It can change. Now, for the terms of this whiteboard exercise, we're going to talk about a loan that's a 7-year loan. What does that mean? It's fixed for 7 years, and then it can change after that. And it can change every year. But let's just look at the math, pros and cons, to help you understand if that might be a fit for you. We're going to take a loan amount of $600,000. This is not a quote of an interest rate. This is not APR and all the expressions and legalities that we need. This is just kind of a simple math calculation to show you the difference. And let's say a 30-year fix is at 6.5%. You'll typically see the ARM, or the adjustable rate, a little bit lower, about 0.375%. Your mortgage payment is $37.92 on the fixed rate. Your mortgage payment, it's a little bit less, $36.45, because the interest rate's a little bit lower. You're going to save $147 a month if you choose the lower rate with an adjustable. But there's some risks to that, and we're going to talk about it. If the rate's fixed for 7 years and then it goes adjustable, the risk happens after year 7. So let's talk about that. You're going to save $147 a month, and over 7 years of the fixed rate, you're going to save almost $12,000. That's real money. That's a lot of money. But you got to be prepared for what may happen in 7 years. On a fixed rate loan, no risk. It'll never change. If you have a 15-year fixed, payment will never change. 30-year fixed, payment will never change. It'll always be the same. And if you want safety and security, that might be a better option for you. It'll never change. You can also refinance at any time. So most people refinance every 7 to 9 years, depending on interest rate cycles. But if you want to take the guesswork out of it, a 30-year fixed or a 15-year fixed, never going to change, no guesswork. Your payment's going to be a little bit more each month. On the adjustable, you will risk a higher rate and payment after the 7 years. So to give you an example, today, if you had a 7-year fixed rate loan that was coming to the adjustable, that interest rate today is about 6.875. Well, 7 years ago, if you would have done a 30-year fixed, you would have been about 5.75%. So what does this tell you? If you wanted a lower rate for the first 7 years, you could have had that. But now your monthly payment's going up after 7 years. Yes, you can refinance it, but it depends where rates are at the time. Again, there's pros and cons to everything, but you have to understand which is going to be best for you. I have a number of clients who choose these loans who think, well, maybe I'm going to move in 3 to 5 years, or maybe I'm going to get an inheritance and I'm going to pay down the loan. And so the first 7 years, I can really use a lower monthly payment. It doesn't matter to me which loan you choose, as long as you understand the pros and cons of each. If you want safety, security, and you never want it to change or go higher, a fixed rate might be better for you. If your current circumstance might allow you to have a loan, in theory, for about 7 years while it's fixed, this could be a scenario for you. One final thing, get off the internet. Because if you're looking to compare these on the internet, all you're going to do is get numbers. A mortgage has become so commoditized where people just think it's a number. It's not. You have to understand the pros and cons of these loans, and most importantly, how it fits your situation. If you're looking to buy or you're looking to refinance, maybe if you currently have an ARM that's getting ready to adjust, reach out to me, send me a copy of the mortgage statement. Let me just look at it and evaluate it and tell you what your options might be. Thanks for listening. Talk to you soon.